Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about something that I think is very important because over the last few weeks, we have spent a lot of time talking about the markets. We've talked a lot about strategies heavily the last few weeks. And today what I want to do is I want to shift gears a little and take a step back from trading, talking about strategy in the markets, and talk about something that I think is actually far more important, which is actually trading psychology. And more importantly, how does it apply to how do you succeed in trading? Because that's why we're all here, right? We're all here because we want to be successful with trading. So I want to discuss why psychology, in my opinion, is so important in being a successful trader. Now, I've been a strategist for 13 years. I've talked to, at this point, thousands of clients, retail, institutional, currencies, futures, Forex, equities, options. And I've spoken to a lot of people with a lot of different strategies and a lot of different outlooks on the market. So I've seen pretty much everything under the sun. And what I've noticed is that there's a clear distinction between successful traders and others as far as how they go about thinking about their trading. So before I get started, I just want to do a quick poll here, right? So if you can please bring up your chat window at the bottom of your screen and just type in, what do you think is the key to success? I just want to hear what some of your answers are. So just type in your chat window, whatever you think is the key to success in trading. Okay, I see some answers here. Strategy, calmness, following your rules, planning, discipline. Very good. A lot of great ones. Consistency, managing risk, patience, money management. I see a lot of great answers here. Rules, research, persistence. Wow, a lot of great answers, I will say. Money management, a lot of you are very spot on, but I want to talk to you about psychology a little bit because I think it's so important in thinking about it from a psychological perspective that hopefully today I can show you one piece of information that may just help you really shift your thinking, because to be successful at trading, the key to it is actually really easy. It's just very difficult to actually change your view on this, to change the way that I'm sorry, it's not easy. It's very simple. I take that back. So it's a simple rule as to how to go about succeeding in trading, but it's one of the hardest things from a psychological perspective to change your way of thinking. So thank you so much for all of your responses. I think many of you are spot on, but hopefully today I'm able to show you why and how you can go about changing your psychology for trading. So first, I want to start by an example. Now, here I have on my chart here a trade that I think many of us can probably at some point in our trading careers relate to, right? So here I have a stock. This stock was, broke out above a $26 resistance level, came to test that level multiple times. So you have kind of like a triple bottom here. So the next time it comes back to retest 26 bucks, what do you think you were going to do? You were going to say, well, I think the stock's it's reached a support level. I think it's going to go higher. So I buy the stock, or I buy a call option, or I sell a put, some type of strategy that allows you to take a bullish view on the stock. What happens next? The stock maybe moves up a little, but starts to drop. What do you do next, right? Sometimes you might say, you know what, let me get out of this trade. But many times we don't, right? And I think many of you can relate to this, where if the stock goes below, goes against you, you start looking at the chart in a different way. Instead of saying, hey, this stock broke its support level, you start to say, well, here's another support level here around 22. So when it gets down to 22, maybe I can buy some more so that I lower my cost basis. So if the stock bounces a little bit, I can make my money back. But instead, stock doesn't do that, continues to move lower. Now you look for other reasons as to why you want to buy. You start looking at momentum indicators and you say, wow, stochastics or RSI has really been oversold for a while. It's got to bounce now, so let me buy some more. Hoping that you get that bounce higher and get yourself back to break even. Next thing you know, the stock continues to move lower and you find yourself in this position where you're constantly trying to buy something that continues to move lower. Maybe you bought some USO when it was trading at $5, $4, $3. I certainly bought some call options on USO as it went down. Guess what? It's not worked out for me. It hasn't worked out for anyone. But this is really the attachment to trading, or the emotional attachment that we have to trading. So if you can relate to this, please type yes into the chat window where a trade goes against you and you chase that trade and you find other reasons as to why you want to be in that trade. So many of you here have raised your hand or said yes. And this is really the start of why many of us struggle with being successful at trading. It's this attachment of being right. It's an attachment to winning. And I'm going to show you in 1 second why that's so important here. Because the attachment to winning and attachment to being right is actually what causes many of us to be unsuccessful in trading. So to understand this, what I'm going to talk about is a little bit about trading psychology. And how do I know that most traders have an issue or an attachment to winning or being right? It's really due to the questions that many of you ask. It's due to the questions that I get every single day. You guys email us questions, people tweet to me on Twitter. There are many times that I get the same repetitive questions that show me that people are attached to winning. So, an example of this is questions like, how do I repair a losing trade? People don't want to let go of a losing trade. They want to win on that trade. They're really, they have a tough time taking on a loss. Another very common question I get is, how do I make my money back on a losing trade? Because big losses require you to get back to break even in order to continue trading. Another common question I get is, what percentage of your trades are winners? Again, focusing on what percentage of winners versus losers. Now, the reason that I say that this is so irrelevant to trading is because there are plenty of people that have 90% winners, but still lose money in their accounts. So does that mean anything if you win 80% of the time, but still lose money in the long run? The answer is no. And lastly, sometimes I get a question from people saying, your trades are terrible. You've had 3 big losses in a row. Again, this tells me that people are not paying attention to the long game, which is what we're playing here, and focus too much on the short-term winning and losing. So to help you understand what I mean by all of this and why I want to show you the difference between winning versus being successful in trading, I'm going to turn to a book that some of you may have heard of, or maybe for those of you that have studied management or studied game theory, you might be familiar with this book written in 1986 by James Pierre Carse, Finite versus Infinite Games. Now, James was not a trader. He was not an investor. He was not a finance professional. He was a religious philosopher. And he came up with this theory that there are 2 types of games, infinite and finite games. And what I want to do is I wanted to show you the difference between the 2 and ask you the question, are you playing the right game? Because if you're playing the wrong game, that's when you can lead to huge losses. And that's what I want to first establish. So let's first talk about finite versus infinite games. So in James's book, he proposes that there is only 2 types of games, finite and infinite. A finite game is a game that we are all familiar with. These are games with a defined set of players and observers. There is a fixed set of rules for the game, and the game will always end at a certain point. And at that certain point, there is declared either a winner or a loser. Now, many of you are familiar with these types of games, and I will go through examples of those in 1 second. On the opposite end of the end, he says there are infinite games. Infinite games are where there are known and unknown players. There are no agreed upon rules, and the game never ends. So what happens in an infinite game is that there's no such thing as winners and losers. What you have are players that are still playing and players that drop out. So there's no such thing as winning. You're either in the game or you choose to no longer participate in the game. Many times that participation is not a choice. It is a being forced out of the game by players who are still in the game. So the question here becomes, which game are you playing? So an example of a finite game, I think most of us are familiar with, is a game like American football, right? You have a set of players, you have a set of fixed rules for games, the game of football, and at the end of the game, there's declared a winner and a loser. What's an example of an infinite game? The National Football League. The National Football League is an example of an infinite game. There's no such thing as winning in the National Football League. There is no, their only goal as the National Football League is to remain in business and make sure that there are no other competing leagues that step on their foot and take away their business, right? Their goal is to maintain dominance in the American football space so that no other leagues can become a dominant player in that particular space. Another example of this, starting a business. There's no rules to starting a business. There's no such thing as winning in starting a business. You are either in business or you are forced out of business. Another example of this is blackjack. This is a game of a finite game. There's a set rules. You have winners and losers at the end of that game. What's an example of an infinite game in this particular case? Running a casino, right? There's no winning or losing in running a casino. You either are continue to run a casino or you can no longer operate as a casino. And this is true for trading as well, because when I listen to what the questions that people ask me as far as trading goes, when you ask about what percentage of winners do you have 3 losing trades in a row, you're terrible. These types of questions that I ask lead me to believe that people are thinking about this as a finite game and not as an infinite game, because trading is clearly an infinite game. It's a game where there are no rules. There's no such thing as winning. The game will never end. You either are in the game or you're forced out of the game. When are you forced out of the game when you're trading? Is when you blow up your entire account and you no longer have enough money to continue trading unless you deposit more money. And that obviously is not a position that any one of us as traders want to believe in or want to be in, where we're forced out of the game because we've blown up our account. So what the question again goes back to, what game are you playing? So here's a very easy diagram to show the frustrations, if you will, of someone who's a finite player but playing an infinite game. And this is what I see a lot of traders do. A lot of traders, what they're doing is they're playing an infinite game as a finite player. And this is a player that's always going to be frustrated because you're trying to win at something that there's no winning at. And this is really why when you're trading, when you're thinking about your trades, don't think about winning. Think about how can I stay in the game? So the question becomes, are you focused in staying in the game or are you focused on winning? If you're focused on the wrong thing, that's when you're going to be frustrated as a trader. When you are focused in the right thing, and a lot of people will say, well, what does staying in the game even mean? And it's really just realizing that you're playing an infinite game. Once you realize you're playing an infinite game, what are you going to do? You're going to change your focus from winning to staying in the game. You're no longer focused on trying to win. You're no longer focused on being right, because that doesn't matter, because that's not the end goal. The end goal is to stay in the game. How do you stay in the game? You protect your account at all costs. You do everything you can to protect your trading account. You do everything you can to minimize your losses so that you never blow up your account, so that you stay in the game and you can continue to trade another day. When you can shift your mental thinking in that particular way and you realize that I'm no longer here to win, it doesn't matter if I win, it only matters if I stay in the game, that's when you're going to shift your thought process from winning to focusing your view on protecting your portfolio. So it's really important. It's such a simple concept to understand, but it's so difficult to wrap your head around sometimes, and it's so difficult to practice. So many of you that answered, money management, discipline, you're all right in the same way. And some of you that said poker is the same way. Exactly. Poker is the same as trading, really. Yes, you can win certain hands, but that's just a finite game inside of an infinite game. And I know that can be confusing, but there are a lot of finite games inside of infinite games. An example of that, again, is like football, right? Football is a game that you can win, but that's inside of the NFL. That is an infinite game. Blackjack is a finite game inside of running a casino, which is an infinite game. Poker, it is a game that has a finite set of rules that you can win and lose at in terms of a hand. But as a poker player, your goal is not to win at hand. Your goal is to make sure that you don't blow up all your chips and lose all your chips. Your goal is to stay in the game. The same thing with trading is that each individual trade that you make, is certainly a finite game, but we're not focused on winning at one single trade or two trades. If you only made one trade in your whole life, then I would agree. But your trading account is not just a single trade. It is thousands of trades over your entire lifetime of trades. And that's what you need to focus on. And that game, in order to win at it, there's no such thing as winning. There's only being able to stay in the game. So I hope that that was useful in helping you guys better understand. And if you want to read more about this, please, there's plenty of research here on, if you just Google finite versus infinite games and read about it. And a lot of it is useful in, there's some fantastic speakers for those of you that follow Simon Sinek. He's got some fantastic TED Talks on this concept of understanding finite versus infinite games for any of you that are managers. I think he's got some extremely great insights to how you can apply this to a lot of other things outside of trading. So I hope that this was useful in helping you guys better understand the psychology and thinking about trading and realizing that you're playing an infinite game, and hopefully that shifts your thinking in terms of how you go about viewing your trading account. So with that, now that I've gone through that, let's talk a little bit about the things that I'm going to go over here. That's going to help you apply this to your real trading account. So we're going to talk about the golden rule of risk management, the #1 rule, and it's a simple rule, very simple rule. We're going to talk about the golden rule of risk management. And in order to help you understand why you need to apply this golden rule of risk management, we're going to go through a few different things. We're going to talk about linear versus exponential functions. That usually, I will say, is a difficult topic to actually convey. However, I will say in this day and age, given the fact that we just went through this whole coronavirus crisis, I think that might be a little easier for some people to understand. We'll talk a little bit about high watermarks, why that's so applicable. We're going to talk a little bit about blowing up your account and how to go about preventing that. We're going to talk a little bit about consecutive losses and the law of large numbers. And lastly, we'll show you some risk and money calculators that you can utilize to help you apply these rules for your trading account. So let's jump right into it. So I'm going to start off with just giving you the answer, right? We're not going to go through the whole presentation. I'm going to give you the answer right up front. And the answer is never risk more than 1 to 2% of your entire portfolio per trade. And what we're going to do is that we're going to spend all this time over the next 20, 30 minutes and show you why that is the case. So the rule here is that depending on your account size, you should risk never anything more than 1 to 2% of your entire account on any single trade. And part of the reason for this, when I talked about that first slide, we were talking about, have you ever found yourself in a position where you bought a stock, the stock went lower, you bought some more, and you kept buying more and more and more, and you couldn't let go of it, and you were attached to being right or attached to winning. Part of it is the psychological concept of not wanting to lose. But the other part is the fact that many traders do not follow this type of rule, and they risk a lot more than 1 to 2% of their account. They might risk 10% of their account on a trade. And what happens when you risk 10% of your account per trade? It really hurts. It gets emotional, right? So you become what many poker players call pot committed, because you've committed so much money to that trade, you have to be right, or else you're going to blow up your entire account or blow up a very large portion of your account. So many times we get emotionally attached to our trades because we've risked so much money. So when you risk 1 to 2% of your account per trade, or a percentage of your account, losses are much easier to let go of because it's a much smaller loss. You realize that there's going to be losers and winners. And again, you're focused on the long game, staying in the game. So what you do is you let go of those losers, and you realize that you still have 98% of your account intact to tackle the next trade. But if you lost 20% on a single trade, now you only have 80% of your portfolio intact. That's a little more difficult to continue trading, or as we'll show you here in a few minutes, is do the math behind that. So the goal here is to stay in the game at all costs by preventing your account from blowing up, by sticking to the 1 to 2% rule. And now what I'll do is I'll show you some of the math behind why we want to do that. So first, to understand that, we're going to talk a little bit about the difference between linear and exponential functions. So a linear function, I think everyone can understand. It is a 1-to-1 or 1 to certain ratio where it's really easy to understand. It's a straight line. exponential functions are very, very difficult to grasp, at least from a conceptual perspective. And that is part of why so many cities and countries around the world responded so late to the coronavirus, despite seeing everything that was happening globally. We saw what happened with China, we saw what happened to Italy, we saw what happened in Korea, yet so many countries, as a result of seeing that, well, basically did nothing because they said, well, we only had 10 cases in our country. We don't have to worry about this. Next thing you know, 10 turned to 11 to 12 to 13. And you say to yourself, well, things are growing so slowly, it doesn't really matter. And that's the tricky part about an exponential curve, is that initially it grows so slow that it doesn't come on anyone's radar until it's a little too late. And then when it grows at an exponential function, that's when it's so hard to control, right? So exponential functions are inherently difficult to conceptually grasp because of how slow they start off, but eventually what happens is it catches up with you. So what happens is that gains compound at an exponential function, and losses also compound as an exponential function. So at first, it might be hard to see it coming, but once it comes, it's really too late. So the goal here is to try to minimize your risk so that you can maintain that upside potential. If you don't control your risk, you will never have that upside potential, because you have this upside potential. As long as you continue to maintain minimizing losses, then you have the potential of growing your account at an exponential function. But if you blow up your account, guess what? You'll never be able to participate in this exponential curve. So that's why it's so important. So now that we have a brief demonstration on kind of linear versus exponential function, now let's talk about how does it apply to your trading account. So first, we want to talk about what does it require you to get back to break even after a loss. And what you'll see is that for every step in loss that you have to get back to break even, those gains grow at an exponential pace. So at first, it doesn't seem like a lot, but once you get past a certain threshold, it grows at an exponential pace. So as you can see, a 10% loss requires a 11% gain to get back to break even. A 20% loss, a 25% gain to back to break even. Doesn't sound like a big difference, but once you start getting a little bit further down the curve into 30, 40%, you start getting into territories where it's almost very difficult to get yourself back to break even. At 30% requires a 43% return to break even. So all of these little green bars look so small, but as you can see, as you get further down the curve, these green bars start getting astronomically large. At 50%, you need a 100% gain. 70%, a 233% gain. At some point, it just becomes ridiculous and there's no way for you to get back. What you basically have to do is deposit more money in order to continue trading. And this is really where you realize that in an infinite game, you get pushed out from being able to participate in that game. And that's the goal here, is to prevent yourself from being pushed out of the game. Now, the rule of thumb here, generally speaking, is that anything below 20%, if you've lost less than 20% of your portfolio, less than 25%, 25% of your portfolio, it's generally, I wouldn't say easy, but it's possible for you to get yourself back to break even. Anything on this side of the curve, it's really difficult to get yourself back to break even. So the goal here is to really do everything you possibly can under the sun to prevent yourself from going beyond that 25% threshold. If you get beyond it, likely you're going to have to deposit some more money into your account to get yourself back to break even, or it's going to take you substantially longer. It might take you a month to lose 25%, but maybe 3 months to get yourself back to break even on that 1 month loss. So it becomes very difficult to get yourself back to break even. So it's really important that whenever you're trading, that you do everything you can to minimize your losses so that your portfolio never reaches, a 25% decline in your portfolio in a short period of time. Now, I just want to make sure everyone understands that. So please type yes into the chat window if this makes sense to you. Okay, perfect. I see a lot of yeses. So now let's talk about the number of trades that it takes to blow up your account. because this also grows at an exponential function. So for every 1% less that you risk on a specific trade, the number of trades that you can make grow at an exponential function. So if you risk 10% of your account per trade, you can have 10 trades before your account is blown up. If you risk 1% less, you can have roughly 11 trades, not a significant account more. If you do 8%, as you can see, initially the growth curve is barely noticeable. But as you get closer to the other end of the curve at 2%, you can now make 50 trades in a row before you blow up your account. Now, chances are, if you're even 20 trades in a row where you're losing trades, maybe you should think about a different strategy. Maybe you should do the opposite strategy of what you're doing. At 1%, you can trade 100 trades before you blow up your account. Very difficult to do 100 losing trades in a row. Now, many people will say, well, even at 10%, I can have 10 losing trades in a row. Why? I don't think I'm going to have 10 losing trades in a row. I'd be pretty bad at trading. But keep in mind that you're trying to prevent yourself from risking no more than 25% of your account. Not just blow up your entire account. You're trying to prevent a 25% loss. If you're risking 10% of your account per trade, you can have a 25% loss very, very easy. You just need 2-3 losing trades and you've blown up 25% of your account. That's why it's so important to be on this end of the curve, because to even blow up 25% of your account at 2%, you need 12 losing trades in a row, 12, 13 losing trades in a row. That's a pretty big number of consecutive losing trades in a row. It might take a very big move in the markets where you have a lot of long positions in order for that to happen. Chances are it's not going to happen on a monthly basis. So that's why it's so important on that. Now, I do want to ask, how many people have been in a position where you've risked more than 1 to 2% of your account per trade? Please type 1 into the chat window if you have risked more than 1 to 2% of your account on every single trade. And I bet every single one of us is guilty of that, because I just don't know any trader that's that disciplined from the very get-go to have completely prevented themselves from risking more than 1 to 2% of their account per trade. So many of you have answered yes here, and that's exactly why this is so important. So now that we've talked about these two things and understanding why sometimes conceptually it's difficult to grasp this, let's talk a little bit about the probability of consecutive losses. And this is where we start getting into the concept of playing an infinite game, because we don't care about a single trade, because a single trade just doesn't matter, especially if you're risking 1 to 2% of your account. Winning here, losing there, it doesn't matter. The only thing that matters is, in the long run, do you have a net positive gain or a net negative gain? And what you want to do is make sure that on that journey of infinite trades, effectively, that you never sustain a portfolio loss of 25%. In order to do that, we just have to turn to probability and the law of large numbers. So what we want to take a look at is the probability of consecutive losses based on your win rate. Now, what determines your win rate? Now, many times your strategy determines your win rate, your directional views, your option strategies. But generally speaking, I would say most option strategies will range somewhere between 30 to 70% win rate in this type of range. On the 30% range, this is predominantly for traders that are likely buying out of the money calls and puts, and you're basically shooting for the fences. You need a big move in the underlying stock in order to be profitable. You're not profitable very often, but when you are, you generally knock it out of the park, right? Think about buying a far out of the money option that costs 20 cents, but most of the time that expires worthless. Once in a while, you get a big move and that 20-cent option turns into a $5 option. You make, 3,000% gain, but the other 80% of the time, you're really losing 20, 30 cents at a time. That's what it feels like to have a win rate of about 30%. On the other end of the spectrum, those of you that sell maybe out of the money puts or sell out of the money credit spreads, you have very high win rates. However, the offset of that is the fact that when you sell these really far out of the money credit spreads for 80, 90% probability of winning, is that when you do lose, you lose big, because every single time you collect a 80% probability credit spread, you might collect $1, but on the back of that, you're risking $9. So yes, you win most of the time, but the few times that you lose, you generally lose big. Is one better than the other? No, it's just a trade-off. And you know, we all have different preferences for trading. Some of us like high probability trades where we risk more. Other ones, we like to risk a little less to try to make more. Now, I tend to prefer more on the lower end of the curve. I like to risk less to try to make more and rely on my directional view to try to win more rather than rely on you know, statistics and probability to sell these out of the money credit spreads and hope that, you know, the probability and statistics hold up. Now, that doesn't mean that I don't trade strategies on the other end of the curve and selling credit spreads. I certainly do, especially in the environments like we currently are. But generally speaking, I rely more so on my directional view, and I prefer strategies that have a better risk to reward ratio. Now, each one of us is a little different. So we're all on the different ends of the spectrum. But what I have here on my chart is just the probability of having the number of consecutive losses based on your win rate. So I would say most people fall somewhere in, fall somewhere here in this particular range, somewhere from 40 to 60%. And what you have here is the probability of having a certain number of consecutive losses. So if you're on my end of the curve, right, maybe you are on 40% win rate, to have 5 or 6 consecutive losses in a row, you have about a 4 to 7% chance that you're going to have 5 to 6 consecutive losses in a row. On the flip side, if you're selling credit spreads, you have maybe a 1 to 0.5% chance of having a 5 to 6 consecutive losses in a row. Now, why is 5 to 6 consecutive losses important? It's because this is just a general rule of thumb that we have in trading, is that no matter how good of a trader you are, there's going to be periods of times where you're just going to have a string of losses. I don't know who here is able to trade in a fashion where you never have 5 to 6 losses in a row. If you please raise your hand if you have had 5 or 6 losses in a row in terms of trading at some point in your career, and maybe type 2 if you think that you've never had 5 or 6 consecutive losses in a row. So 1 if you have, 2 if you think that you haven't. Okay, so I see a couple of 2s, but predominantly I think the answer here is 1, because at some point you're always going to have a string of bad luck, or maybe you just have a lot of long positions like we did perhaps in February, and the market sold very heavily off. You're just going to have at some point where you're going to have 5 or 6 consecutive losses in a row. So, and what you want to do is you want to be able to plan for that. You want to say that if that happens, am I going to lose more than 25% of my portfolio? So if the goal is to keep the amount that you risk in your entire portfolio to be less than 25% of your entire portfolio, then you can use this tool to give you a sense for what is the probability of you losing 5 to 6 consecutive losses in a row. So if I'm risking 2% of my account per trade, if I'm risking 2% of my account per trade, and I have 5 consecutive losses in a row. So what I have here is that at 50% win rate, I have about a 3% chance that I'm going to sustain a 10% portfolio loss. Now, if my win rate's 50%, I feel pretty comfortable with this idea that I have a 3% chance of losing 10% of my portfolio, and my chances of losing 25% of my portfolio is significantly less than 3%. That's a probability that I can deal with, meaning it would take a pretty significant or black swan event. Perhaps the coronavirus might be an example of black swan event, but it would really take something like that for me to be in a position where I've lost more than 25% of my portfolio. That's a number that I can swallow. That's a range that I can deal with. However, I think reality many times for us is that many times we might lose, let me see if I can. So, but the reality here is that many of us, we don't just trade one trade at a time, right? Because the reality many times is that we trade multiple trades that all expire on the same expiration date. So the May expiration, the monthly expiration is coming up next. Maybe you have 5 trades that all expire in May, and maybe they're all long trades, or maybe they're all short trades. So what you have to realize is that you can't just think about each trade individually. You have to think, do some trades belong in the same group? Meaning, if you have 5 long trades that all expire in May, that doesn't count as 5 separate trades. That really counts, in my perspective, as really just one trade. So if you add up all of the long trades for a single expiration cycle together, what you might find is that you're not risking 2% of their account for that trade. You're actually risking maybe 10% of your account for that one expiration cycle. And that changes the math a little, because now if I have five trades per expiration cycle and I'm planning for 5 consecutive losses, now I have about a 3% chance of a 50% portfolio loss, not just a 3% chance of a 10 or 20% portfolio loss. Now, if let's say I traded 2 expiration trades per cycle, then I have a 3% chance of a 20% portfolio loss. So you have to think when you're doing this type of math and you're thinking about how much capital do I need to deploy to each trade, you have to not just think about it from a per trade perspective. You actually think about, do I have concentrated positions? So especially if you have multiple long tech names that all expire next month, guess what? You have to group those together as one trade and think about how much risk do you have on that one group trade, not as them as individual trades. Now, if let's say you have, I don't know, one long technology play and one short utilities play that expire in May, you can think of those, in my opinion, as 2 separate trades, because you're talking about long short, you're talking about different sectors, even though they expire on the same day. But again, many times that's not how our portfolios are constructed. Many times we tend to have more concentrated position. And that's part of the reason why at OptionsPlay, we don't like to just go all long or all short and, long all the same sectors or short all the same sectors. We like to spread our risk around so that, sometimes we have a bunch of longs that expire. We have longs and shorts so that when the markets move up, we take profit on the longs. When the markets move down, we take profits on the shorts, and vice versa. So that's how we like to spread our risk around. And you can see that in our daily plays. We never really have concentrated positions in one sector all expiring on the same day. So make sure you also think about applying that for your own portfolio when you're doing your thinking. Next, what I want to talk a little bit about are stop losses, because this is an additional tool that you have to help you offset some of that risk, right? So when we talk about, especially many times we may have multiple long positions expiring on the same expiration date. Maybe you have, let's say, 3 long tech names all expiring the same expiration date. Each one of those trades are risking 2% of your account per trade. So you're saying that you're risking 6% of your account on that trade. But what you can reduce that 6% down to a lower percentage by using stop losses, right? So if you have discipline, and many of you answered discipline in the first, when I asked the first question, what do you think is necessary for successful trading? Stop losses can help you, if you apply them with discipline, can help you reduce your risk. So stop losses can reduce the percentage of the account of the trade that's risk. So if, let's say, if you have a stop loss at 50%, meaning if you buy a call option at $1 and you always stop yourself out at 50 cents and move on to the next trade, then what you've effectively done is you've reduced your portfolio risk by half. Now, I will say that even though as disciplined as we might want to be at 50%, many times the market doesn't allow us to do that, because the market can gap below our stop prices. So usually, even if we say we want to have a stop loss at 50%, reality is you might be closer to 60%, in my opinion, at least from my experience from trading. Markets gap lower, I cut a loss at 60%, 70%, but overall that averages out to maybe around that 60% level, even though you intend on having a stop loss at about 50%. So that's another way that you can reduce your risk. So if we're looking at a risk of 2% of your account per trade, and you're accounting for 5 consecutive losses, that again is a 3.3% chance of a 10% portfolio loss. But if you apply it with a 50% stop loss, then you have a 3.3% chance of a 5% portfolio loss if you are able to disciplinedly apply that stop loss. So that is some of the math behind managing your portfolio, doing everything you can to minimize your losses, and making sure that you never blow up more than 25% of your portfolio if you can follow these types of rules and think about how you're spreading your risk on trades, because it's not just each individual trade, it's how you're grouping your trades together across expirations, across long short, and across the different sectors. So make sure that you think about that when you're trading. So just to sum up some of the stuff that we're talking about here, let's see. So I want to talk a little bit about going back to what we first started, right? We talked about having never risking more than 1 to 2% of your account per trade. So the dollar amount at risk per trade is really what you need to have a number in your head. So what I have here is a simple graph here, depending on your account value, what dollar amount you can risk per trade. So if you have a $10,000 account, the number you should really be focusing on is $200. No matter what options, what trade you're making, you should never exceed $200. Now, what that means is that many times, if you have a $10,000 trading account and you're thinking about trading, let's say Netflix, and Netflix is trading at $450, guess what? You're unlikely going to find an option that's priced at $200. That means that Netflix is out of the question for trading, meaning you have to choose lower price stocks. You should never exceed this number just because a price, you're trying to trade a stock that's a higher price stock. So keep that in mind. So before we move on, before we talk about anything else, make a mental note to yourself. What is your account value? What's the 2% of that account value? And make a mental note to yourself. And at all costs, never exceed that amount of risk per trade. Because again, we're playing an infinite game. To stay in that game, you need to make sure that you minimize your losses. You need to make sure that you don't blow up your account, because if you blow up your account, you are no longer a player in this game. And that's how we become unsuccessful at trading. So what I have here is, let's say you have a $50,000 portfolio, 2% of that is $1,000. That means that every single trade that you make, you cannot risk more than $1,000. So if you're trading something that has $200 of risk per contract, you can trade a total of 5 contracts. And keep in mind, you have to make sure that you look at the max risk of a strategy, because you could sell a credit spread where maybe you're collecting, let's say $200, but on the back of that, maybe you're risking $500 on that trade. What you need to focus on is not the $200 that you're collecting, but the max risk, the $500 number. That's the number that you have to match up with your max risk. So if you're selling a credit spread where your margin requirement is $500, instead of being able to trade 5 contracts, you're only able to trade 2 contracts, because each contract risks $500. So that's why it's so important to make sure that you know this number off the back of your head. You should know this number at all times, and you should know how to make sure that you calculate the appropriate number of contracts for trading. And for that, what we did is we've created a very simple spreadsheet that you guys can access actually, we've updated this link, but you can use this link as well. Whoops. I will post this link into the chat window for everyone here. But what we created is a spreadsheet calculator that allows you to do this calculation on your own. You can type in your account value. Whoops, keep pressing it. You can type in your account value. You can put in what percentage of your account you're willing to risk. This defaults to 2%, and we'll spit out the dollar amount you can risk per trade. And you can also put in this calculator the amount that you're willing to, the max risk on a specific trade, and it'll calculate the number of contracts that you can trade. So this calculator was built for you to easily do that, but I will say that we actually do these calculations for you here in OptionsPlay. So regardless of what strategy you're looking at, even on a credit spread, I was looking at a credit spread on Eli Lilly before. So what you can do is you can use our risk and investment calculator. An investment calculator, you can say, I'm willing to risk $1,400. So in this previous example, I had a $70,000 trading account. So the most I can risk is $1,400. So what this automatically calculates for me is that I can sell 2 contracts of this Eli Lilly put vertical, which collects $540 in income. And my max risk here is $960, because if I did 3 contracts, I would exceed the $1,400 risk. Now, maybe in this particular case, you could maybe trade 3 contracts. It's $1,440. That's close enough, but make sure that you never exceed that dollar amount by more than, I would say, $30-40 at most for your trades, even if you trade an additional contract. So here you can collect $810 in premium as opposed to $540 if I only traded 2 contracts. So making sure that you know what your maximum risk is so important for trading, because again, remember, when you're trading options or when you're trading, You're playing in an infinite game. Stop trying to win. Do everything you can to stay in the game by protecting your account. That's the most important thing. And that is how successful traders think. They don't think about winning. They think about, how do I protect my portfolio? How do I make sure that I maintain enough of an account balance to continue trading and not get forced out of the game by blowing up my account? To do that, it's really simple. Never risk more than 1 to 2% of your account per trade. That is one of the best ways to protect your portfolio and protect your chips, and make sure that you maintain the ability to minimize your portfolio drawdown, and make sure that when you're trading, that you're planning for at least 5 to 6 consecutive losses in a row, because at some point in your trading career, that will happen. And you want to make sure that when it does happen, it doesn't cause you to blow up your entire account. When you're risking 10% of your account per trade and you get that 5 consecutive losses, now you've lost 50% of your portfolio, and you need 100% gain just to get back to break even. And that becomes a very, very big task to overcome. And lastly, when you're thinking about risk, think about distributing your trades across expirations, across sectors, and across being long short. Because if you're focused on all long trades in the same sector, all expiring the same day, guess what? You haven't spread out your risk, and you're actually risking substantially more than what you think you might be risking on a specific trade. So with that, that's what I wanted to discuss with you here today. Nothing to do with trading, really just talking about the psychology of trading, thinking about how you want to position yourself, and thinking about what game are you playing. Because when you realize that you're not playing a finite game and you're playing an infinite game, you will switch your thinking immediately from winning into, how do I make sure I stay in this game? And when you shift your thinking that way, that is when the reality of trading completely changes for you. And hopefully that helps you better understand how you can position yourself to become successful as a trader. So with that, I want to thank everyone for taking the time out here this afternoon. I hope that you guys find this useful. So at this point, what I'll do is I'll open this up for Q&A. If you have any questions, please type them into the Q&A window, please. I want to answer as many questions as I can, but the chat becomes really a little difficult to answer all your questions. So please type them into the Q&A window, and I'll answer questions out of that. In the meantime, I hope that you guys find this content useful. You know, we are here every single week for you to make sure that we provide valuable insights to trading, to your accounts for analysis, making sure that you guys get trade ideas from us, education from us, as well as we continue to improve our platform. So I hope that you guys consider supporting us by becoming a member. You can go to trade.optionsplay.com/join. Membership is just $75 a month or $500 a year. And for those of you that do not already have access to OptionsPlay, you can sign up for a free trial using the optionsplay.com. You can sign up for a free 30-day trial, get access to everything, try it out before you commit to a membership. So thank you so much again, everyone. So let's take a look at the questions here. Do you suggest applying this rule to the investment side of your account? So I will say the investment side of your account is a little different. But generally speaking, you know, this is really where diversification comes in as well, right? If you look at the rules of diversification, even if you hold 20 stocks in your portfolio, it really becomes quite difficult for you to lose or blow up your entire account across 20 stocks. So yes, the rules do apply when you're investing, but generally speaking, you don't have to necessarily apply the 2% rule. It's closer, I would say, to the 5% rule when you're thinking about stocks and ETFs. Praveen is asking, buy below intrinsic value and sell at or above real value, Benjamin Graham. So absolutely, but I will say that you can attempt to buy below intrinsic and sell above real value, but still blow up your entire account doing that, because markets can stay irrational longer than you can stay solvent. And if any of you have realized that, you know, that's really the key to risk management. You could be right in the long run, but actually not have enough money to sustain the holding on to a trade to prove yourself right. So stop proving yourself right. Stop trying to win. Make sure that you prevent yourself from blowing up your account. To use the same 1 to 2% rule to buying stocks, I just answered that question. What is your formula using to get 5 contracts for $200 risk per contract, assuming it's a $50,000 portfolio? Let's see if I have that Excel sheet up here. 1 second. Let me just go to that link, actually. Is OptionsPlay a paid service? Yes, it is a paid service, but it's a free 30-day trial for you to try it out. And then after those 30 days, it's just $300, $75 a month or $500 a year. So let me download this contract calculator for you and show you how it works. So the answer was, how do you get to, so $50,000 portfolio, 2% of that is $1,000. So you can risk $1,000 per trade. So if you have a trade that you're risking $200 on, you can trade a total number of 5 contracts for that trade. So that's how you get to that answer. Would average down strategy apply to options? Average down applies to any strategy, but again, averaging down is not letting go of a loser. It's again continuing to try to win on every single trade. And once you realize that you don't have to win on every single trade, and the goal is not to win on every single trade, that doesn't help you at all to win on every single trade. By trying to win on every trade is really when people lose all of their money. Because in that first slide, as I showed you here, let me see if I can back up to that very first slide. Let's see, let me find it here. Why people blow up their accounts. It's this particular trade, right? This is averaging down. Averaging down can cause very, very big losses in your portfolio. And this is when you are not thinking about the long run. You're not thinking about how do I stay in the game. You're thinking about how do I win. And when you think about how do I win, that's when you lose at the infinite game. And that's why we have this slide up here. What game are you playing? If you are a finite player trying to win in an infinite game, guess what? That's when you're going to lose. And I hope that that is what I was able to convey to everyone here today, why it's so important to think about what game are you playing and make sure that you're not playing a finite game in an infinite game. What's your view on Gilead given the data leak today? I actually didn't know about any data leaks. The stock I think was doing pretty well earlier today, but I think it was down, right? At the end of the day, yeah, it was down 4.3%. I'm glad we took profits on this yesterday. Stock's still above that $75 level. We had the put vertical that was a $75 level, so still above our strike price, but we've already took profits on this. I really didn't know about the data leak, to be perfectly honest. So for example, if you buy a call or put, don't pay more than 1 to 2% of what is available in my account. Also, if I sell a call or put, don't let the amount to be risked more than 1 to 2% of my available account. I will say that when you're selling a put option to buy a stock, you might, like I said, when you're buying a stock, it's a little different. I think with the stock, you can probably risk up to 5% of your account per trade. So if you're selling a put option, I do think that you have a little bit more leeway because your risk there is truly if the stock goes to 0, right? The chances of that are pretty low. When you buy a call option, the chance of you losing 100% of your investment is actually pretty high. So the two I don't think are comparable. How do you feel about stop losses on credit spreads? You should have a stop loss on all strategies, including credit spreads. For credit spreads, should the estimated risk be the margin requirement? Yes, it should be the margin requirement is the max risk of a credit spread. Jonathan, you mentioned using stop losses to minimize risk. Is it possible to use stop loss orders with option spreads? Yes, it is, but it depends on your broker. So different brokers have different support for stop losses on multi-leg orders. So you must contact your broker and ask them what type of orders they support and whether or not they support a stop loss on a option spread. Link for the calculator. I'll just post this link right here into the chat window. So for those of you that want to copy to the link to this calculator, I just posted that link into the chat window. Not an important question, but you are obviously Oriental. I am Chinese and Japanese. Rob, how does gamma affect the option price when it is a lot higher than delta? So gamma is really something that you have to worry about near expiration if your option is near the money. Gamma is really only a factor that comes really into play near expiration, or at least gamma exposure. Otherwise, gamma is just increasing or decreasing your leverage.
in a credit spread, is it ever proper to? And then it gets cut off. So Stephen, if you can finish that question, I'm happy to answer that question. Kenton, I grew up in New York. Hi, Tony, just joined the site, loved it so far. Would you trade options in an account under 5K? You absolutely can, but as you can see, the max risk that you can risk is only about $100 per contract, and there are not a lot of options that are available for $100 or less, which means that in order to trade options to account under 5K, you're risking more of your account. Now, maybe with a smaller account, maybe it's easier for you to redeposit money, but again, it would be a very uphill battle, in my opinion, to trade an options account with less than $5,000. So I'm just being honest with you, James. I'm not trying to discourage you from trading options. I just want to make sure that you understand the reality. Can you apply stop losses to options? Yes, you can. You just have to ask your broker as far as what type of options orders they support. I'm on a trial, but I'm not getting a daily play idea, just T-Doc on Monday, why not? So Peter, you should have gotten, the trades that we've sent. If you got the T-Doc one, then you should have gotten the other ones. If you don't mind, send me an email at info@optionsplay.com, and I'm happy to answer look into your account and see whether or not you're getting those emails. Regarding the stop loss, probability of touching is greater than probability of loss, especially below 50% loss for options. Any thoughts on that? Casey, so you're absolutely right, but that doesn't mean that you shouldn't cut your losses when you have lost 50% of your trade. What we generally find is that once you've lost 50% of the trade, your chances of breaking even and getting yourself back to being profitable is so low. That's why that it's better to preserve the remaining 50% and apply that to the next trade, because that's half of your next trade. You have a much higher probability of winning on that trade than getting yourself a break even on a trade that's already gone against you. Chris, what is the full watch sale rules? Great question, Chris. I'll be honest, I'm not I don't day trade options, so I don't know the rules for options and watch sale rules. Or rarely have I gotten in and out of the same options, and I just print out my tax forms at the end of the year and hand it to my accountant. So I'll be perfectly honest, I'm not a tax attorney, or should I be giving tax advice? So I think that you should turn to a tax professional for that question, Chris. Take a trade, it doesn't meet the minimum credit. Take a trade if it doesn't meet the minimum credit. Stephen, I'm not sure if that's a question. If you could please, I posted the link to the spreadsheet in the other room. Wallace, if you send me an email regarding your question about Options Pro 365, send it to me at info@optionsplay.com. I'm happy to answer that question for you, and we're happy to accommodate that as well. Is Options Play available as a software to run via a website? How do you customize the site? Yeah, it's absolutely available. So Praveen, sounds like you probably don't have a free trial yet. So please go to optionsplay.com, sign up for the free trial, test it out, and see if it's a platform for you. Please clarify risk per trade. If I'm selling a cash covered put, how do I calculate the risk per trade? So a cash covered put, your maximum risk is the margin requirement. But again, when you're referring to a stock trade, like a cash secured put, you can risk, in my opinion, up to 5% of your portfolio on that cash secured put. So if you have a $100,000 portfolio, a cash secured put of $5,000 is usually a good limit to sell for a cash secured put. How do we interpret the options play score? The options play score is so an options play score is a finite game inside of an infinite game. It's really looking at each trade as a finite game, as a winning and losing with the probability of winning and losing, and it's telling you what are your chances of winning on that trade. So in this particular case, in GILD, buying this call spread, the $77.5, $87 call spread for $6.14, guess what? Probability on that trade, not very good. That's how you interpret the options play score. Red scores are poor risk to reward. Green scores are better risk to reward. Yellow scores are average risk to reward, and green scores are great risk to reward. So it's really taking a look at the risk to reward of each trade. Jonathan, I appreciate your comment. I really do. Sherry, I just joined. Do you personally always use the 50% stop loss? Yes, that is a rule that we always keep to. I will say that there, we are, at the end of the day, we are not robots. We are all human beings, and we have at times exceeded our rules, right? Especially if we have a high conviction of a trade. And this is really where, when you stay within your 2% rule, you have leeway to not take a loss when you need to, because I've defined my risk at 2% of my account per trade, so that when I take that trade, I'm fully ready at the end of the day that the trade can go completely against me and for me to lose that 2%. So yes, I do try to stay with that 50% rule, but sometimes on a high conviction trade, I will stick to that trade for a little longer. Like, what we have with AMD and some of the other trades that went to 70, 80% loss before it came back down and we took losses, on there, because I had a high conviction that the stock was going to reverse lower. So you can deviate from that 50% stop rule if and only if you always stick to your 2% rule. If you don't stick to the 2% rule, then that's, I've heard of people, they'll say, well, then I'll just risk 4% of my account per trade, and then I'll do a stop loss of 50%. And guess what? Sometimes you get emotional on a trade and you say, I know it's going to turn around, so you don't take that stop loss. Next thing you know, you blow up 4% of your account on that trade. So that's really where, in my opinion, you absolutely should, but we also have to give ourselves a little bit of leeway, because we're not robots. We are human beings. We do have convictions, and sometimes when we make our trades, and we may not always take a stop loss at exactly the time that we think we can. And many times you don't want to place an order as a stop loss, because sometimes you get stopped out because of a wide bid-ask spread, and then the market comes right back in your favor. So those are some of the things that it's just a reality of trading. So if you stick to a 2% rule, you're more likely to be able to take a loss also. What to do with the credit spread that generates less than the desired credit? You shouldn't take that credit spread to begin with if it generates less than the desired credit. And usually the desired credit is 1/3 of the width. If you're collecting less than 1/3 of the width, it's generally speaking, in my opinion, not a desirable credit spread. I was able to go to a lighter color using profile settings. Great, Praveen. Carlo, does your strategy change daily depending on the direction of the market? So yes, we always have a macro view in the back of our head when we're looking at trading ideas. If we're very bullish on the markets, it's very rare that we'll look at bearish strategies. But normally we don't like to have all bullish trades. We always like to sprinkle a couple of short trades in there. Vice versa, if we're bearish the market, we always like to have a couple of long trades, especially for strong stocks, because no matter how bullish or bearish the markets are, you will always have some stocks that are counter-cyclical to that, right? So look at TDOC and Zoom. These are stocks that are continuing to do very well as the market sold off. And vice versa, when the markets are rallying very strongly, there are always going to be stocks that are weak. So you always want to play both sides of the game. You never want to leverage all of your capital in just one side of the market. What's the options site in Canada? It's optionsplay.com/TMX if you want to access that. What option strategies can I do in a Roth or IRA compared to a personal account? That depends on your broker. Different brokers allow a lot of other strategies. Some brokers restrict your strategies heavily. So Malcolm, it depends on your broker. How do we interpret the bell curve shape? The bell curve shape is really just telling you what is the expected range of a stock based on a certain expiration date. So you can choose an expiration date, and we'll calculate the expected range based on probabilities for where that stock will trade in. So very useful in helping you decide strike prices if you're going to sell strike prices. So if you're selling covered calls, you're selling credit spreads, if you're selling buying debit spreads, you can use these curves to help you determine where you want to sell those strike prices. What's the highest score? The highest score for the OptionsPlay score is 250. Do you have a spreadsheet that will calculate P&L based on the type, credit, and other data? Well, we don't have a spreadsheet. We have a whole program for it. So if you want to trade buying a stock, buying a call spread, you can choose where you think the stock's going to go at what point in the future, and you can even make some volatility assumptions, and we'll calculate for you your expected profit right here on the screen. Eduardo, you should only place a trade when OptionsPlay score is above 100 in green. Generally speaking, anything that's yellow or green is acceptable. I generally avoid anything that's red. Yellow means that it's average risk to reward ratio. I'll still take something with average risk to reward ratio if I have strong convictions, but you'll see that most of our daily plays almost always will have a green OptionsPlay score. Do you have any figures on how many times the OptionsPlay score was over 100 and finishes a positive trade? The reason that we don't have those statistics is because there are literally trillions and trillions of possible combinations of strategies. We can't possibly calculate that on all the strategies. But I will say we're doing a lot of that research right now. We're doing some research into, how, when the probability skews in your favor, what are the percentages of winners in that? It is something that me and my quants are currently working on. Hopefully we have some research to share with you soon, DJ. Jim, is it a good policy to exit a vertical spread when you have made 80% of max profit? So absolutely. So, it depends on when you say vertical spread, whether you mean a debit or a credit. On a credit, absolutely. On a debit, I would say that's generally true as well. 80% of max profit on a debit spread. You would probably be pretty close to about 100% gain on the debit spread, if not more. So yes, I would say that that applies for both debit and credits. Is your full service part of Chaikin Analytics? No, the Chaikin Analytics platform is just a slimmed down version of what you get here. It doesn't include any of the education, doesn't include the trade ideas. Here, only at OptionsPlay do you get the full platform, the education, the daily trading ideas, as well as the Tuesday and Friday market outlooks. That was something I didn't get a chance to really discuss here, but we do have Tuesday and Friday morning outlooks. I hope some of you are able to join us for that here. Every 9 a.m. And I do have Michael Coe with me here next Tuesday. And I know he was supposed to join us a couple of weeks ago, but he wasn't able to make it. But he is going to be here on Tuesday. We'll basically be reviewing the markets together. We'll talk a little bit about maybe some of the trades that we discussed tomorrow night on CNBC, give you a little bit more insights to some of those trades. Scott, isn't just putting on a spread itself kind of a way to have a stop loss? Absolutely. So that's part of why we trade spreads, is because the spread itself has defined risk. But when you buy a debit spread for, let's say, $2, and that debit spread, sometime in the future is only worth $1, that generally means the trade that you expected to happen or the directional view that you expected is not working out. And you're better off saving that other 50% of that trade for your next trade, as opposed to just letting that evaporate to zero, and hoping that you get some miracle jump in the stock that you may get in the last few days. Are these recorded for future reference? All of our webinars are recorded for future reference. Do Chaikin Analytics customers get OptionsPlay? No, they do not get the OptionsPlay daily play ideas. How often are thesis often as the strategy is updated? Because I've seen different recommendations different times after or before market. Our trades always go out at the same time every single day at 6 a.m. Eastern time, and is always emailed to you 3.5 hours before the open. We do that so that you have consistency on all of our trades. Can you elaborate a bit on the technical score? The technical score, great question. The technical score is a relative strength indicator. So it tells you how strong a stock is compared to other stocks in the market. So it's a great way to give you a sense for whether a stock is outperforming or underperforming the market. It doesn't tell you direction. It tells you whether a stock is outperforming. So, you could have the whole market decline 50%, but the stock that's only down 10% or 20% are going to be the strongest stocks in the market. So it's not a bullish or bearish indicator. It's telling you how it's performing against the other markets. For bullish or bearish, you want to turn to the 1 month and 6 month trend. That's going to tell you whether the stock is trending higher or lower. And you want to use the two in conjunction with each other in order to better understand how to trade. How does Best Buy Bed Bath & Beyond keep going up? I'm not sure. I actually haven't looked at that stock, to be perfectly honest, James. So I couldn't help really answer that question. Wayne, what do you think is the best use of our time for the infinite game? Learning to make better decisions through focusing on technical analysis, or learning the mechanics of an options trade and using expected ranges to place our trades? Wayne, I would say that I would first focus on the mechanics of an options trade, then focus on the directional view using technical analysis. Both are important, But I would say none of those things are useful if you are not sticking to the proper rules of risk management, because it doesn't matter how great your directional view is. Eventually, you're going to have some losing trades. You just want to make sure that when you do have those losing trades, you don't blow up your whole account. Could or should you consider roll out the trade on a spread that still has 50% left of what is criteria to, and what is the criteria to do that? So Stanley, the question to ask yourself is, if you were not in a losing trade, would you enter a brand new trade on that symbol right now? If the answer is yes, then go ahead and roll your trade. If the answer is no, then don't roll your trade. Take the 50% that's left and move on to the next trade. I generally find that when I ask myself that question, 9 out of 10 times, the answer is no, I would not get into a brand new trade if I wasn't already in a losing trade. Raj is saying, say if the May 29th trade is going well and in your favor, do you wait for more gains, pull the trigger, or close if you can realize, say, 30% profit? So Raj, it depends on the market, right? So when things are very volatile, I tend to find that you might want to take profits a little quicker, a little easier, or maybe roll a trade prior so that you can lock in some profits and still maintain some upside. So when things are very volatile, you generally want to take profits a little quicker. When things are calmer, you can kind of let the market ride and keep, hopefully let it continue in the direction that you expect it to. How is the 1 month and 6 month trend determined? It's based on the moving averages. It's the triple moving average. It's a proprietary system that we've created. We've been using it since day one that we've created this platform. We have not changed that formula, and many of you use it in your trading every single day. Do you always use a 50% rule on exit a profit on an option? We use a 75% rule for profit, 50% rule for stop loss. Do you have a practical rule on when you should fix a trade or just take a loss? So the practical rule is, if you weren't already in a losing trade, would you enter a new trade? If the answer is yes, then you might want to repair that trade. If the answer is no, then you want to take that loss and move on. Connor saying, great stuff, Tony. Thanks on selling bear call spreads when you're in the money. Where is the best time frame typically to close out a trade considering time decay? When you're selling a credit spread, the best time to close out that trade is usually 2 to 3 weeks from expiration. When you hold your credit spread into the last 2 weeks, that's when you start getting gamma risk, gamma exposure. You generally want to avoid that. So I've answered all of your questions. Now, I know a lot of people have submitted some questions in the chats. I'll try to get to a few of them, but I don't have a lot more time here. I'll try to get to some of them. Let's see. Thanks for the insights. Trades on the same expiration. You're very welcome. Good to see your restraint in these challenging times based on the apparent unchanging alcohol levels on the shelves in the background based on presentations from a few days ago. That's my Scotch collection. I dip into that not as frequently these days. I much prefer a beer at the end of the day. So cheers to those of you that like to have a beer or a Scotch at the end of the day. Susan, thank you so much. I really appreciate it. Paul, same thing. Manny is asking, Tony, thank you so much for spending the time and doing a great job at education, especially for non-members, since all of us can't afford your OptionsPlay fees, especially in these tough times. Manny, I hope that you get yourself through these times, and hopefully that you're able to join us as soon as you can. Trading, thank you so much, Tony, for excellent webinar. You're very welcome. Wallace, yes, these will be posted on YouTube, usually about an hour afterwards. Joan, you're very welcome. Frederick, when selling a put, how do you define a 1% loss? So when you're selling a put, your margin requirement is your max loss. And like I said, when you're selling a put, you can usually get up to about a 5%, 5 to 7% in my opinion, for a short put, your margin requirement of your entire account. Is it unreasonable that a good OptionsPlay score translates to a good options trade? Not at all, Roger. So Rogers brings up a really good question. His question is, does an OptionsPlay score, a good OptionsPlay score, translate to a good options? Oh, sorry. Does it translate to a good options price? The answer is yes, because high OptionsPlay score simply means that the price is in your favor. So whether you're buying, if it's low, it'll give you a higher OptionsPlay score. If you're selling, then the higher the price, the higher the OptionsPlay score. So yes, that is true, Roger, that's true. But I will say that a high options play score does not mean that it's a good options trade, because this options play score just tells me that buying a call spread here on GLD is cheap. But a cheap trade does not mean that it's a good trade, because no matter how cheap these calls are, the stock still needs to go higher in order to be profitable. And if you think GLD is going to go lower, it doesn't matter how cheap that call option is, you should not buy a call option if you think the stock is going to move lower. So Roger, great question. Sorry I butchered that first part. Lauren, can you post the Excel sheet link? I just posted that into the chat window. Thanks for this wonderful webinar. Who do I seek to overcome? Finite versus infinite game is a new concept. I will say that I highly recommend many of you who are interested in learning to just Google that, because it is applicable to a lot of things outside of trading. Can you comment on when to use credit spreads, risk of calculation of selling? So Suki, I have a whole webinar on that. I actually have a whole webinar on debit versus credit spreads. So a little too long for me to answer that question right now, but I will post a link to our playlist, which has that, that video in it. So please look it up on our playlist, and I highly recommend you to take a look at that. Arlene, Tony, I got an alert. Arlene, if you have an alert on that, please send us an email at info@optionsplay.com if you have a question about that. How to close the GILD trade. I don't know what you mean by how to close it. If you don't know how to close a trade, I would say that you should contact your broker and ask them to show you how to do that on your platform, because it really just depends on your platform. Will you be discussing the Intel trade? It's down after hours. Where is Intel trading at? $55. Wow. Okay. So Intel taking a very different approach than the other semiconductor stocks. So we will definitely be sending out an update on that. I'm going to have to do a little bit more research. On credit spreads, how long should we stay in to realize profits? Generally speaking, you want to avoid, you generally want to close a credit spread within the last 2 weeks. You don't want to hold it to expiration. Can you do options on $2 and $3 stocks? You can. Think about USO. It's a $2 stock. You can certainly buy $2 options on it. There's not many, and they're generally very expensive because $2 to $3 stocks tend to be very volatile. So be very careful. Even though they're cheap, they are also relatively to the stock price very expensive. Wayne, you're very welcome. I really hope that you continue to be part of this and be a participant. I really appreciate you being here. Bars, do you have any favorite go-to option strategies that you like the most? I would say debit and credit spreads are by far my favorite option strategies. You could do 2 times at 4x and take a 50% loss. That was exactly what I was hoping that people did not take away from that presentation, Bruce. I don't want you to take a 4% risk and then just apply a 50% stop loss, because we both know that it's not always possible to get always stopped out at exactly 50%. And we know that emotionally, we don't always stick to that rule as much as we want to, and as disciplined as we are, as we want to be as traders. It never happens 100% of the time. So don't do that, in my opinion, Bruce. Chris is saying, tell them to play poker with pennies this weekend to learn more about the risk of ruin. Absolutely. I highly recommend people to learn discipline and trading by playing cash games in poker with pennies. It is a great way to, in my opinion, to learn about how to play a finite game inside of an infinite game. Tony is doing the Lord's work here, preventing us from ruin, hopefully make some gains. Chris, thank you so much. I really appreciate it. Is it best to stop loss and sell it or let it expire? I think it's better to take a loss, keep some money so that you can apply that to the next trade. So even if you keep 25% of the original trade, now you have a quarter of the capital to apply to your next trade. Whenever you can to take a stop loss on a trade that you know is not going to work out and you're likely going to let it expire worthless, take the profit, take the credit. You know, there's no reason that you shouldn't take what's yours and apply it to the next trade. Don't you get what you paid for when it expires? Not sure what that, don't you get what you paid for when it expires? Stephen, not sure what you mean by that. Please, if you don't mind rephrasing, happy to look at that. What percentage of the stock price would you recommend spending on a leap? I usually would say that, you know, when you buy a 60 delta 1-year option, you're usually in the, it really depends on the volatility of the stock, but most stocks that I would buy a leap on, which generally speaking are generally more larger cap names or more liquid names, it's usually in the 15 to 20% range, I generally have found. But again, this market is a little crazy, volatility is a little higher. I think you're going to see a lot of them probably trade in the 20 to 25% range. Tony, I usually trade with 80 to 90% out of the money naked short puts with $2,500. An example, Boeing strike of 85 short put. What do you think about that? So a short put is a little different because that's a stock that you want to buy. But I will say that you're not collecting much premium on that for that $2,500 risk. Chances are, you know, you could have been doing that same 80 to 90% risk on Boeing when I was trading at 300. Guess what? For the few dollars that you would have picked up in premium, you would have lost tens of thousands of dollars on the back end of that. So that, in my opinion, is not thinking about playing an infinite game. That's thinking about how do I win most of the trades that I do. And that is, again, the fallacy of what brings down those traders is trying to win all the time. By selling that 85, 90% out of the money naked short, what you're focusing on is short-term gains, and you're not focusing on what is my long-term risk and how do I make sure that I don't blow up my account, because selling those 80 to 90% naked short puts is a great way to blow up your account at some point. May not happen for a while, but when it does, it hurts. So Ali, I hope that you think about that next time you're selling these really far out of the money puts, because what that tells me is you're trying to play a finite game inside of an infinite game. Why can't we get any suggestions from the software for iron condors or butterflies? It's not that we don't want to provide iron condors or butterflies, but if you think about an iron condors or butterflies, number one, I think most people don't realize that an iron condor and butterfly is really a true volatility strategy. It is not a directional strategy. And I don't know about you, but I don't have a forecaster for volatility. I don't have a way to tell you when I think volatility is going to go lower. I haven't seen a great tool that predicts volatility. Maybe you do. If you do, then you can certainly trade iron condors or butterflies. The other thing about iron condors or butterflies is that you're basically selling a put and a call credit spread at the same time. A put credit spread is a neutral, slightly bullish strategy. A call credit spread is a neutral, slightly bearish strategy. So I don't know about you, but I'm never in a position where I'm both bullish or bearish on the same stock. You know, you can make an argument of playing an iron condor going into a earnings play because you think the stock's going to make a move, maybe slightly higher, slightly lower, so you trade that iron condor. But the problem there is that you have to hold that all the way through expiration. I just think that there are better strategies to trade than an iron condor or butterfly. But if you want to do that, you certainly can. So you can click on modify, use a strategy constructor, use an iron condor and iron butterfly, and you can certainly select this on your own. And this is really where the trading range simulator is very useful, because you can say, well, I think GLD is going to trade within this particular range, or whatever range you think it's going to trade in, and you can use our P&L simulator and you can use our strategy constructor to construct a iron condor or butterfly that fits your range. And you can do it visually. You don't have to even fiddle with the strikes and the expiration drop downs. You can just move your strikes up one, down one. You can make it wider. You can make it narrower, all with a click of a mouse, and fit the range that you expect that stock to trade in. So you absolutely can use OptionsPlay for iron condors and butterflies. Can you please comment on unusual options activity? I would say unusual options activity is one of those things that certain people likes and certain people just hate. I will say that I've never really followed a trade on unusual options activity. They like to talk about it on CNBC. I will say that because it is sometimes useful as a learning experience, because you can see how professionals or how institutional managers are utilizing options. I don't really believe in following those trades and trading the exact same trades, or taking their views and expressing it, because, you know, and this is something that Tom Sosnoff and I talked about on the last time that he was on in December, and I'm going to have him back here in June, which is that, you know, they've tracked these unusual activity trades. It's about a 50-50 shot as far as whether they're profitable or not. So there isn't a lot of evidence that these unusual activity trades end up being profitable. How often do you send out trades? We send out every single day. You know, they're not always opening transactions. They're sometimes closing transactions. We've sent out a lot of opening transactions in the last few weeks, which is why now we're focusing on closing those trades before adding more exposure. And again, this is also trying to keep so that we don't blow up our entire accounts, because if you have 30 open trades, guess what? You have a lot of exposure out there. It doesn't make sense. Whenever you start getting a higher number of trades, focus more on closing those trades before you start opening more trades. So thank you so much. I really appreciate it. What you teach and provide for free is worth much more than the $500 a year. Wayne, thank you so much. I really appreciate it. Arlene, do you close this trade this AM? How do both legs have to be closed? Yes, both legs have to be closed on a spread like this. For everyone that said thank you, I really appreciate it. I know so many of you have said thanks. I unfortunately can't get to all of your names, but thank you so much. And again, are you using a lot of time value to buy a 1 or 2 year leap? So this is why I think that when you're buying a leap, you want to buy something that's in the money, so that you're paying less you're paying less in extrinsic value. When I'm looking at a leap, I'm usually looking at how much extrinsic value am I paying, and how much of that extrinsic value is a percentage of the underlying stock price. So you generally want to avoid the extrinsic value, and you can do that by buying usually about a slightly in the money call option. When you use a risk reversal trade is really just shorting a put and buying a call. That's it. And it's useful when you want to have a short-term exposure that's very similar to the stock, is when you would generally use a risk reversal. What is your definition of far out of the money? Anything lower than, I'd say, a 25 delta is probably far out of the money. Okay, that's the end of it for today. Again, I want to thank you so much to everyone that has stayed on for this whole time. There still have so many of you that have stayed on past the hour-and-a-half mark. I really appreciate you guys taking the time. I hope that you guys find this useful, because I do think this is one of the most important topics to talk about with respect to options trading and just trading in general, and making sure that you have the tools that you need to become successful as traders. So thank you so much. I hope you guys have a great evening. I hope to see many of you tomorrow morning on our Friday morning market outlook, and we'll send you the recording here as soon as we're done here today. Thank you so much, and have a great evening.